You know that sound and you know the time of day that brings on the closing bell at the New York Stock Exchange,
Right.
4 p.m., and there we go.
It was a tough day for the stock market. The Dow Jones fell more than 330 points.
Yeah, that's right. The S&P 500 and NASDAQ saw similar losses. Each fell about 1%. See how underwhelmed we are by these terrible numbers?
Terrible numbers.
What does it all mean? Joining us now is Brian Vendig. He's the president at MJP Wealth Advisors. What do you make of this, Brian? Underwhelming day? And if so, what's behind it?
Thanks, Errol. Yes, I think right now what we're seeing this week specifically within the market is that a continued drumbeat of economic data is showing that inflation is coming in a little hotter than investors expected to kick off 2023. And I think with the recent Federal Reserve meeting and knowing that there's other policy decisions in front of us in May and as well as in March, where the Federal Reserve is probably going to continue to increase interest rates to fight inflation, it's causing investor concern because, again, market valuations are under pressure, saying our stocks getting a little bit too ahead of themselves, considering that the Fed might have to continue to tighten on rates, slow demand, slow the economy down to continue to fight inflation? Or is it that the Federal Reserve policy measures have done as much as they can do to fight inflation, and that this is actually more issues outside of the Fed that is outside of their control? And I think that's also giving some investors some pause this week as well.
Yeah, let's talk about inflation a bit more, because new data from the Commerce Department showed that inflation accelerated in January. And, for some time, it felt like we were talking about inflation slowing just a bit. So what is driving this latest increase?
That's a great point, Elaine. I think what right now we're seeing within the economy is it's a mixed picture. Last year we saw inflation definitely peaked in June, steadily came down over the course of the year. We got to core inflation to be under 6%. But most recently, headline and core inflation really didn't come down very much over the last month or so when we look at things from December to January. And some recent inflation indicators today show that it came a little hotter than expected. And I think what's driving that is the fact that the consumer is continuing to spend. We're still seeing elevated spending from the consumer. We see credit card balances going up. We still see healthy incomes year over year, and balance sheets are strong. We also still see that around the world that there still are inefficiencies in the supply chain that is keeping cost for things elevated. And also domestically, we see that the services sector of the economy is still maintaining itself in demand for professional services, healthcare services, travel and leisure is still in demand. So with all those things being said, price for things are still sticky and hanging around a little bit longer with a higher wage environment, a higher cost environment. And also there's a little bit of a lag factor, Elaine, I would also say, on housing prices. We're seeing those prices coming down, but that's not happening as fast as people expected. So that's why I think some of these numbers are staying a little elevated, and people are concerned about where the economy is going to go over the next couple of months.
And then all the data, the new data you really just laid out, Brian, is that enough, in your view, to convince the Federal Reserve to change its current interest rate strategy? Or does something else need to be done completely? As you mentioned, some of these things are outside of the Fed's control.
Errol, that's an excellent point, because that is really what's causing, if we go back to the point about the markets this week or even just today, that uncertainty on exactly what the Fed might do on these next two policy decisions is what's giving investors, and I think all of us, a little bit of pause, because I think earlier this year, people were expecting that the Federal Reserve would increase interest rates at around 0.25%, maybe over the next one or two policy meetings. Now that we're seeing that inflation is a little stickier due to some of those reasons that I mentioned before, it's possible that in this March meeting, they might have to increase rates by 0.5% and also continue to increase one time before they take a pause on their rate tightening cycle. So I think right now we need a little bit more information to feel convinced that the Fed is really going to increase rates to 0.5% in March. I would say it's fair to assume that over the next two policy decisions, interest rates will be increased by 0.5% in total, with a risk that it could go up another 0.75%. And we should all expect that short-term interest rates are going to be at around 5.25% by the time we reach mid-year. So these are all things I think that are necessary to continue to ensure that inflation is in check. But I do think from an economic perspective and from investors' perspective, as we move through the next couple of months, it's not necessarily a bad news story for our economy. I think the economy will slow, but over the second half of the year into next year, I think we should expect to see a recovery for not only the stock market, but as well as for the economic environment.
But pretty significant if that, in fact, happens here. And really, you can see the Fed trying to tap the brakes even more forcefully on inflation. Brian Vendig, Brian, thank you so much for sharing your insight and analysis with us. We appreciate it.
Thanks, Brian.
Thank you both.